Hello?
Good afternoon.
Good afternoon. So we have a couple of people still joining.
Oh,
Can you see me?
Yes, we can.
Okay, good. So,
oh,
Tanya? Tanya, can you hear us?
Yes, I can.
Okay, good. Still joining. So let's start with this class, and then before moving into the new part, Tanya, did you attend the previous class?
Yes, I did.
Good. Can you say something about what you remember about the previous class?
We talked about premium risk, about how it impacts overall, including the time value, the risk and inflation on the default process when we have trades.
Mhm. That's it?
Well, that's a short summary of that.
Well, but it's not even a minute, so I don't ask you to do.
Oh, okay. Well, it depends on, for example, we talked about also about the GDP, the nominal and the real GDP, the interest rate, how it affects when we have different trades among people, about how they have different values depending on the time. For example, one person, well, we had examples about pizzas and bananas too, so that you can't eat a pizza depending on the time period when you give the loan, for example. And
Just a second. So why you give a loan then if you cannot eat the pizza?
to have the interest rate.
So what do you exchange in this case? You exchange pizza for what?
For the more income, the interest rate that you get more at the end.
So you exchange a pizza now for a pizza and a half, for example, two pizza in
The future.
in the future, correct? Very good. So Tanya, that's fine. So Daria, did you attend the class last time?
Sorry, well, can you hear me?
Yes, I can. Can you hear me?
Great. I had to leave really early on, but I got the gist of what you did.
So do you have any additional comment with respect to what your colleague Tanya said?
I didn't hear it all because I didn't hear all of it because I just connected, but well, I think I don't have any comments just now.
Okay. Joseph?
Yes, I also connected when Tanya ended her speech, so I heard a little bit about the interest rate, so I also didn't have any comments.
Yekaterina?
I don't know, did she mention about the risks? And we said that we have 3 types of risk last time.
Which kind of risks?
Like 3 components of like interest of inflation and time value and the like risk itself. Just risk of default.
But time value is a risk?
No, it's like part of the component of interest.
So say it again. What are the risks?
Risk of default.
Yes.
Of inflation. And I thought that it was the component of like because person is not capable of use his own money and he have a compensation because of it.
No, it's not that. Nadia?
Yes.
Which kind of risks?
I remember risk of time that with time the value of money can change. Maybe the risk of rate that also could change.
Dimitri?
Yeah. What's the question? One more time.
Is the same question.
About the risk?
Yes.
Sorry, I've missed the last class, so I don't get it.
And then Anton?
Also, risk depends on class of country. For example, risks of investments in the USA and in Libya will be different because the USA is developed country and Libya is a developing country.
Yeah, what I showed you a table, and what was in that table with the different interest rates?
There were different risks of different treasures bills.
Not only that. Can you remember the table?
So.
Okay, this is a methodological note. Every time that I start a new class, I recall something about the old one. So please try to, I don't say to study, but try to read what you have done or what we have done in the previous class. Because this is important. I understand that maybe you don't have time to really study, but try to read it, okay? Okay, so now let's switch this. Let me show my screen. Let's see if we can do it. Can you see the presentation?
Yes.
Okay. Do you remember which page we stopped last time? Yes or no?
Yes, it was the one with the table.
Sorry?
It was the one with the table.
This one, no? Okay, and then let's move forward. So this table, can you say what is about this table? So just last time as a repetition. Hello?
I can try.
Yes.
It was about one thing, that the risk depends on the maturity of the bill.
Good.
That if you invest money for a longer period, you want greater interest because you are risking more.
Correct.
And
you risk
another
more.
thing,
You risk more because of what? Daria, you said correctly.
Because anything can happen in that longer period.
Okay, good. So let's go.
And another thing was that the AAA corporate bonds are better than BAA corporate bonds, and that's better, meaning more secure, that you can count on them paying back in greater likelihood than the BAA corporate bonds. And that's why you want greater interest on BAA corporate bonds.
Okay, so if you invest in more risky asset, you want more?
Yes.
What do you want more if you're risking if you invest in a more risky asset?
You want greater expected revenue, like interest.
You want a higher higher return. So as we said, risk return are correlated. If you see on the market something that is very rewarding, it means what?
That it's really risky.
Correct. Good. So let's move forward. And then I think that we already mentioned this, the real interest risk-free rate. I'm pretty sure that we mentioned it. Daria, can you confirm it or am I mistaken?
This one, I'm not sure if like you stopped exactly on this slide, but probably maybe you mentioned in your speech.
Anyhow, there is a risk-free rate. What is the meaning of risk-free rate? Let me ask Vladislav.
Can you repeat, please, what you have asked?
Sorry?
Can you repeat, please, what you have asked me?
Yes. What is the meaning of this, of risk-free rate? This thing. Can you read it?
I can make an error, but as I remember, it's the risk. It's a risk rate that doesn't depend on any parameters.
No.
No, okay. I can't answer.
Anna?
I think risk-free rate is a rate of a hypothetical investment with scheduled payments.
No. What is the meaning of risk-free? in English, or in what is the meaning? Risk-free.
Maybe it's a return of investment with zero risks.
Risk-free, without talking about investment, is without risk, no risk, risk-free. Okay, there is no risk. And then we have this, after risk-free, we have this word, rate, no? And then this rate is, okay, it means the return that you get in something that has no risk. It's clear what I mean? Hello?
Yes.
Anton.
Yes.
So there are securities or investments, whatever, that can provide a return without any risk. So then we will see later during the class if this is true or not. But let's say that, let's assume for the time being there is something that is risk-free. So without any risk. And then there is this word before everything that is real. And what is the opposite of real when we talk about investments?
Nominal.
Correct. Who said that? Nick. I guess that we already mentioned. So real is not the opposite of unreal, but is the opposite of nominal. So when we have an investment, we have to evaluate if there is inflation or not. So let's say that there is an inflation equal to, I don't know, 5%, and we get a return of 7%. What you have to do in order to understand how much in reality you got?
The inflation is 7%, correct?
No, you got the reward is 10%, and the inflation is 5%. What you have to do?
We need to divide.
Go ahead, sir. What do you want to divide?
1.05 divided by 1.07, and that would be real rate of return.
No, it's not exactly this. What you can do, I understand what you mean, and it's not exactly this. What you can do is just approximately, you have to do this. 7% is what you got, no? And you do just simply start. This is return. I'm going to write it, okay? Inflation. Can you read the chat?
We can.
Yes.
So just do this. It's very simple, but because this is just to understand the matter. So you have nominal, you have inflation, and then in order to assess how much you got in real terms, you deduct from the nominal, you deduct the inflation. And then you know that in reality, your real reward was 2%, not 7%. Okay, it's clear to everyone.
Yes.
Okay, Vladislav, I need you put the camera on. Otherwise, I will kick you out of the meeting. Okay, and this is valid for everyone. You are me on the screen. I want you on the screen. Хорошо?
Да, хорошо.
Very good. Okay, so now, what are the issues here? That there are different time preference of individuals. We mentioned before pizza, for example, no? And there are people that are willing to exchange one pizza now for 2 pizza in a week, but they are not available to wait for a year or for two years or for 6 months, whatever. It's clear what I mean?
Yes.
Okay, so everyone has a different preference regarding this exchange of in time, no? So again, there are people that can wait a week. There are people that cannot wait a week. There are people that can wait a year. There are people that cannot wait a year. So that's why it's subjective. Okay. And then there is something that is objective, and there are the different kind of opportunities available. So, for example, if you are in a country in which you can invest today and get a return of 7%, what we said before, or in a country where you invest today and you get a return of 2%, back to the example, no? This is another example.
Countries don't have the same kind of preferences as individuals do, don't they? It's the measure of a risk, no?
Please, can you see the chart now?
Yes.
Yes.
Okay, good. So there are situations in which you don't have this 7%. But the best investment that you can make is 3%. So in reality, you get -2 real. So what is the point? That there are ranges of opportunities that are not always advantageous and they are always profitable. Sometimes it's better, I don't know, instead to invest in securities, to run your company or to buy your pizza. Because if you invest that money, you will get a negative interest rate. You see what I mean?
Yes.
Anna, is clear?
Yeah.
Good. So, as I said, there are subjective things and also objective ones that are the opportunities that you are available. So, for example, for a long time we had negative interest rates because the interest rates were so low that I'm not sure about Russia, but for sure regarding the West, the interest rates were so low that the liquidity was so high because we had this kind of helicopter money. I don't know if you heard this expression. Do you know this helicopter money?
Yeah.
Yeah.
I heard it.
Okay. Then, because of so much money was pumped by the central banks in the system, then the interest rates were very, very low because of the very high liquidity. And for Germany or for other countries like the United States and so on, there were instances in which the real interest rate, but also the nominal, not only the real, but also the nominal interest rate was negative. And then now we have higher interest rates, but we have much higher inflation. So again, we have a set of opportunities that often provides negative returns. Not always, but in many cases, you have this kind of situation in which it's better to consume or to invest the money in your own business, your own company, than to give your money to someone else. It's clear what I mean or not?
Yes, it is.
Okay, good. And then here we have the nominal risk. Before we said the real and then the nominal. Again, we have objective things, subjective things, and among the subjective things, we have this the expected rate of inflation, because we know the inflation today. But if we invest in a bond that has a maturity of 5 years, then we should understand, we should try to guess what is the inflation, not only today, but we should make an expectation about the inflation from now to next 5 years. Is clear? And then who said this? Here there are the formulas. No, I made a simplification before, but if you want to use correctly the formula, you have to use these ones. Okay, this is for nominal, this is for real. I guess that Vladimir mentioned this, no?
No, it was
Fyodor, sorry. Fyodor, those are the formulas, okay? This is what maybe you wanted to mention before.
Yes, exactly.
You missed the -1, and you must be careful about what is the numerator and what is the denominator. Yes?
Yes.
Good. Okay, and then we have different kind of risk premium. Why? We said that there are investments that we assume that are without risk, even though everything has a risk. But we can assume that in some instances there are risk-free. But what do we mean by risk-free? Anna. Anna, can you hear me?
Could you repeat the question?
Meaning of risk-free.
I can't understand your question because of problems with connection.
Anna, it's the same question that I asked before. What is the risk-free? Igor? What is it? Dorot. Can you help me to read this this name, because I am not good. Ignat. Can you answer? Okay.
May I try?
Yeah, are you live?
Let me answer the question.
Okay, so just a second. I am kicking out your friend.
Okay.
Okay, Iñat is not anymore with us. So, yes.
When
Go ahead.
when we do not have a risk lose our finance over a period of time.
Good. Okay. So again, just a second. So we have situations in which we said that there is no risk, but then when we have a risk, then we require a premium. And why? Because we are concerned about what can happen to our investment. So there are different kind of risks. We already mentioned some, and here there is an additional list. So we have the business risk. Then, for example, let's say that you have a company, and this company is producing, I don't know, ski or ice creams. And let's say that the summer is very, very cold. Do you think that you will make more money or less money?
Less money.
Okay. You have a business, and then it could be that your business is not going well because of the climate. And then let's make another example. Do you know Nokia?
We do.
Nokia.
We know.
Nick, you are talking?
Yes, it's a famous mobile company, phone company.
So Nokia was is a Finnish company, no? And then was making boots, kind of. How do you call it? Varenki? You understand? Boots, Varenki.
Like boots from wool, right? Pretty.
Shoes, kind of shoes, boots.
Okay.
How do you call it? Yeah. Is this the right word in Russian? Can you see the chat?
It's pronounced Valenki.
Sorry, Valenki. Okay, sorry for the translation. So was making this, and then this company switched to mobile phones. And it was the most successful company in the world regarding mobile phones. But do you have which kind of phones you have at the moment?
iPhones or Samsung.
Yeah, they are called mobile phones, or in a different way?
Smartphones.
Smartphones. So this company was not able to develop the new technology that was smartphones. So this is business risk. This company was very good in changing business, but then was not able to develop this new technology. And a similar thing is for BlackBerry. Do you know this company, BlackBerry?
Yes.
So they made very good phones, but then they used the normal keyboard for writing the messages, and then they were not able to develop this new technology that is smartphone, that is about smartphone. So you have a business risk because of climate, business risk because you run a business, and then that business is dependent on the technological progress, and if you don't keep it, if you don't make enough research and development, then the company is going to have problems. So next thing is finance risk, liquidity, exchange rate, and so this is something that you can read by yourself. You don't need my explanations. And country risk, political risk, and so on. Okay, you don't need my explanations, but next time that we meet, next time should be tomorrow, correct?
No, I don't think so.
Let me check it. Let me check the calendar.
The
When
day
is
after
it?
tomorrow.
The 15th. Yes? Next time will be in 2 days' time, on Thursday, correct?
Yes.
Okay, so on Thursday you will tell me if you understood this, and then the definition of this kind of risks. So, okay. And then let's move forward. Well, there are those risks that we mentioned, and then there is this Markowitz portfolio theory and so on. Did you read something about this?
Yes, we have encountered such a term in one of our previous lectures.
Okay, so everyone, correct? Good. So let me go ahead, and now I'll show you an example. There are two countries here, okay? You know that I'm Italian, and then I make comparison with other countries like Germany. And we already mentioned this. What's the stronger economy, Italy or Germany?
Probably Germany.
Correct. And then try to expand this. So this is Italy, and this is generic government 10 years here. This is not recent, but it doesn't matter. It's just an example, okay? This is from Bloomberg. Do you know what is Bloomberg?
It's a magazine. It's a financial magazine.
Well, not really. It's an info provider, information provider. Then you have also news there and so on. But essentially, there on Bloomberg, you can find almost all securities that are traded in the world. So if you want to know, I don't know, what is the interest rate on 10 years Italian treasuries, then you have to enter this code and you will get it. And that is for Italy, and this is for Germany. And in your opinion, this is, you know, that in Italy and in Germany, we have the same currency. That is what?
Euro.
Euro. And then let's talk about Russia. How many currency you have in Russia?
One, Russian ruble.
Russian ruble.
Correct. And then you have just one interest rate. Correct?
Yes.
Okay. But in Europe, this is strange that we have the same currency but different interest rates. And then why there is this difference between the interest rate that you get if you invest on Italian bond, interest rate if you get if you invest on a German bond?
It's probably because German bonds are considered less risky, so they require a lesser return than more risky Italian bonds.
Correct. So that is because of the country risk. That is something that we mentioned before. You see, country risk. It's clear? So you have many kind of risks. Here I made some examples. We said that also we have business risk, liquidity risk, and so on. And this is an example. So if you invest in a German bond, you get 0. If you invest in Italian bond, you get 1.3. Okay, and this is an example again about country risk. And then let's talk about business risk. Huh? So do you know what is a Tesla?
Yes, it's a tech company that makes electric cars.
Okay, so it's essentially it's a car company, but they make electric cars. And then let me ask someone. Elvira.
Yes.
So Elvira, do you like cars?
Yes.
So what you will buy? I don't know, a Tesla car or a Mercedes, for example?
Or what?
What you would buy? Which kind of car you would buy? Electric car or traditional one?
Traditional one, because in Russia we haven't opportunities to use the electric car.
Let's say that you are in Russia, but you can use also electric car. What you would buy?
Let me think. I don't know.
Okay, Dimitri?
Yeah, I think it depends on the mood. If I like Rotatata, I'll use a traditional car, and if I care about the nature, about the nature, of course I'll use a Tesla or something like that.
But did you make an evaluation? Did you made an evaluation regarding the environment? So, do you know if really electric car is more environmentally friendly than traditional car?
It's very hard to estimate it because we don't know how to utilize the components of the electric car. But in perspective, it's better to use electric cars because we think that humanity is developing and we will know how to work with what electric car makes.
Okay, then maybe you can do this by yourself, this kind of investigation, and then you will find that is not true at all, that electric cars are more friendly to the environment than traditional cars, especially the cars that have this kind of measures on the amount of the fuel that is burned and also the pollution and so on. So this is one matter. But anyhow, this is what Andrei said. This is about the future. So if you are an analyst, let's say that you need to understand for your company what is the best investment. If you want to invest in automotive, where you should invest. So so back to you. Let's just a second. I'm still starting with your names. Elvira, no?
Me?
Yes. So, if you are an analyst, in what market, in which company you would like to invest?
I think we should invest into Tesla because in the future this car will cost more. I think so.
Which car will cost more?
Tesla.
But if it costs more, then you have less clients. It's clear what I mean?
No.
Let's say that you sell two cars that more or less are the same. In your opinion, the customers, what will buy? The more expensive or the cheaper one?
I don't know because it depends on what I like. Don't know.
Elvira, there is always this law between demand and offer. And what says this law? When the demand will increase?
Demand will increase. When the bonds of the company will increase.
No, let's talk. Let's say that you sell whatever, any good, it can be pizza, can be cars, whatever. When you will get more customers, in which case?
When customers want to buy it.
More customers. In which case you get more customers? Whatever is the good, it can be a car, can be pizza, can be Valenki, whatever.
I don't know.
Dimitri?
Maybe in the case when a product is more popular, more prestigious, for example.
No, the basic thing, Dimitri. What is the basic thing about demand?
When a product is cheaper, then the demand is bigger.
Okay. It's clear?
The price doesn't influence the function of the demand itself. It influences only the equilibrium quantity. It's not the factor to increase the demand as a function.
No, you will get more customers if you sell for a cheaper price. Nick, this is the basic thing about
yes, but the demand, the function itself is the same.
Yeah, but we don't care about the function. We are not talking about it. We are talking about the number of customers. So if you reduce the price, you will get more customers. And the opposite if you increase the price. So Elvira, is this clear to you now?
Yes, it is clear.
Good. But then you have not only the current situation, but you have the future, and then you can say, okay, let's think about not today, but what are the perspective, and then you see that Tesla is worth more. The company Tesla is worth more than FCA because because the future for Tesla is bright. Many people will buy more and more electric cars, and then instead the future of traditional cars is not so bright because they are going to lose the market. Is the example that we made before regarding the business risk and Nokia, no BlackBerry. So you see, the sales for FCA is for almost 5 million of cars, and the total sales for Tesla is about it was about 22,000 cars. But if you have a look at the total value, the market capitalization. By the way, do you know that what is the meaning of market capitalization, Elia?
No, I don't.
Daria?
It's how much the company's equity is worth altogether.
Yes, correct. So normally what you do, you take the number times the price. It's what it's written in the chat. Hello?
Yes, it is.
Okay, so what you do, you consider by market capitalization how much is worth your company. So here there is a problem. So you see, FCA is worth much less than Tesla. You see, 35 billion against 15. Sorry for this, that is not clear. And then if we have a look at the ratios, you see it's price per earnings. You know the meaning of this ratio?
It's a ratio of the price of equity to company's earnings.
Sorry, say it better because I don't understand it.
Per share.
Again, say it again.
It's a ratio of the price.
Yes.
Of a share to company's earnings, and also we multiply this by the number of shares outstanding.
No, it's per shares. Per share means for each single share.
Yeah. I mean, we.
You shouldn't multiply. You take the price of of the share, and you divide it for the earnings of the company. And this is positive. Instead, if we have a look at the earnings per share or the P ratio for the Tesla, what do you see? Otabek.
Yeah.
What do you see?
So earning per share of Tesla company.
Yeah, you have to compare that with the earning per share of FCA.
I cannot find it on this chart. Could you please say?
You have to focus on the class. Yes. Then when you finish the class, you do whatever you like. But for, I don't know, 20 minutes, 40 minutes, 1 hour, you focus on the class.
I'm focusing on the class, but I'm asking the question, where are the earnings per share? I cannot see them. Yeah, I see. They're not available on this picture.
Or the price earning ratio.
Price earning ratio is 3.77, or I cannot see that number. 6.77.
Let me expand it, okay?
Yeah. So, yeah, it's something like 6.77.
Yeah.
And if you take Tesla Motors, it's minus 6.32. It means that we actually have earning per share. No. Earning per share is minus 6.32, and price earning ratio is minus 32.92.
Okay, you have to compare this PE ratio with the PE of FCA with the PE ratio of Tesla.
I should compare what? EPS with the PE ratio?
PE. Can you see this?
Yeah, I see the PE.
Okay, so what can you see then?
I see that it's negative. Yes, it's negative.
Okay, so it's negative. And then what is your comment?
I can say that earnings are probably negative in this company.
Yes.
Because otherwise it couldn't be negative.
And then you have market cap. What is bigger? Which one is bigger?
Market capitalization in the second case is higher, almost twice.
So what is your comment? You have compared two numbers between the two companies. What is your comment?
We can see that P/E ratio of the first company is positive, and in case of Tesla, it's negative. It means that in case of Tesla, earning per share is probably negative. It's actually negative, but in the second company, it's probably positive, even though it's not available in this case. I mean, on the chart. So it's probably more. It's probably more reasonable to invest in the first company rather than in Tesla.
But in reality, we don't have. We have exactly the opposite. That the first company should be is profitable. It should be more reasonable to invest in the first company. The first company is producing almost 5 million cars. The second is producing 22,000 cars. So why people invest in Tesla and not in FCA?
So it's probably more of a trend to invest in Tesla. So a lot of people don't analyze deeply some of the basic indicators, and follow the trend that that other people follow on social media and in some other sources. But as we see on the upper chart, FCE is probably more reasonable. I mean, it has more sense to invest in FCE.
But actually, we don't know how much investments Tesla did or something like this by these charts. Maybe Tesla had a lot of investments, and we see that because of market capitalization, Tesla has some money to make these investments real. And in this case, it's kind of work on the future to invest in Tesla. So.
Okay, Andre, so you got it. So it's what we said before. And you have different kind of business risk because maybe, like the example that we have before with Nokia, this market, the traditional car market, is going to collapse, so is declining, and then Tesla instead is better positioned to be in the future in the new market. And also because the investments. So there are two things. It could be that Tesla is investing more than FCA, but also we said depends on the quality of this investment. You can invest in an old technology or in a new technology. Anyway, when there are trends, it could be that those trends in business could be that they are not rational, that they are following what is a kind of narrative. So let's say that you have a solid car, and instead you don't buy this solid car that is a good car, but you buy another car that maybe is bad, just because it's cool or is trendy, whatever. It's clear what I mean, Andre?
Not exactly.
So let's say that you have good meat, and then you have a good restaurant, good traditional Russian food, no? Instead, you have on next door, you have a McDonald's. In which restaurant you go?
It depends on me, how much money I have in the pocket and how much time I have.
No, let's say that they cost the same.
Okay. McDonald's or a normal restaurant? I'll go to a restaurant, I think.
Okay, because maybe you are not influenced by so much by social media, whatever. But there are people that maybe go to McDonald's not because the food is good, but just because it's trendy. It's clear what I mean?
Yeah, I understand what you mean.
Or there are people that buy certain clothes not because they are good, but just because they are trendy. And the same for phones. Maybe you have a good smartphone, but you change it because it's not anymore cool. It's clear what I mean?
Yeah.
Good. So now I guess that we have interruption, or I'm mistaken? No, until 1640, correct?
Yes.
Okay, so let's continue.
So they have a question. Isn't the situation is like a market bubble? No, when people invest in something that is not really value of this.
Yeah, this is true. Also, Alphabet. Yeah, I didn't notice the McDonald's. But what you have? Точка. You have something different. Точка. What else?
Вкусная точка.
Sorry?
Вкусная точка.
Вкусная точка. Okay. Okay. So yes, you are right, Dimitri. Say it again, please.
Sorry?
You said something. Can you say it again?
No.
And who said that? Who asked the question? Sorry.
I've asked, isn't the situation is like a market bubble when people invest in market when they shouldn't do that?
Well, there are two things in finance, in economics. The normal assumption is that people are rational. And why we want to be rational? Because between two things, we need to assess what is the best in terms of return and risk reward, independent on whatever is a trend or any other thing. But in reality, we know that people are not rational. And that's why there is something that is called behavioral finance. Do you know this term? Nick, you said that. Can you say to your colleagues what is about?
Behavioral finance?
Yeah.
So I don't really know much about it, but I guess that it's the way of studying finance with the understanding that our agents aren't rational; they are humans, and therefore some assumptions just don't hold, and we need other approaches.
Correct. So that is the idea. So they depart from the assumption of rationality, and because of this, they studied how this discipline studies how people in reality behave. Not so. And the behavior is the way in which people act. So that could be for investment, that could be for shopping, that could be for anything, okay? Because again, in reality, we are not rational. Okay, and this is something that I will skip because we already studied this. Just to mention what we said before, that there is a kind of trade-off between what is the risk and what is the return. So if you have higher risk, then you have higher return, and the opposite. This is what you already studied, so I will not. You just read it. I will not explain it. But let's talk about indices. There are several markets, and those markets are related, I don't know, to derivatives, to bonds, equities, and so on. And why they are relevant? Well, because in a market, you find a combination of goods, no? And that combination of goods give you a representation of what is your opportunity of investment. And we said at the beginning, no, before, let me move back. If you remember, we said this. Do you remember this?
We do.
Good. So we need different kind of opportunities in order to make comparison, in order to decide what is better in terms of risk and reward. And then how we can assess those opportunities, how can assess the risk and the reward of those opportunities. Well, a way is to identify a market, as we said before. So we try to identify a market, and then you build an index. Who is able to tell me what is an index?
index?
Yes.
Index
Market index
is some representative indicator of that consists of some objective data in the market, available in the market, driven just that we derive from available information. In other words, how to say?
Well, if we are talking about market indices specifically, they show how changes the price. For example, S&P 500 tracks the price of shares of 500 biggest companies on the market in USA. If I, yeah.
But I cannot see you moving. Can you move, please?
Yes, just my camera is like that. Oh, is broken. I don't know what the issue is. I will try to fix it.
Yes, please do it. Daria, what is an index for your opinion?
Well, I think the index as a function should be monotonous in the sense that it's kind of orders, I don't know, the bond issues or the equity issues according to some measure which someone chooses, for example, the revenue or the security, something like that.
Well, index. So go ahead. Sorry. Go ahead, please.
Well, I just wanted to say that it's kind of an ordering of something based on some criteria.
Okay, index is an indication of the market, and then is a particular indication in the sense that it is built in a way that tells you if we talk about apples, because there are different kind of apples, for example, Daria, different kind of cars, different kind of, what is it? Daria, anything? So you have different kind of goods. And then you have an index for apples and an index for cars and so on. And this index represents the market, for example, for cars. Represents the market of apples, whatever, no? And when we talk, so we have a market, we have a representation of the market, that is the index. And then when we have security, it means that we talk not about apples maybe, but we talk about bonds, equities, or derivatives, whatever, okay? And so it's a sample. An index often is a sample, so it doesn't represent all kind of apples that are sold on the market. So let me try. Vladislav, can you tell me, please, what is a sample?
I can see.
What is a sample? You have an idea what is a sample?
I can answer this question.
Vladislav, what did you say?
I can't say anything about this.
You cannot.
Yes, I cannot.
Okay. No, let me check this. Anton?
I think sample is a particular group of something. In our case, companies.
In this case, sorry, what is written here? Are you sure that are companies? What is written? Can you read it?
The security market indices are a sample of their relevant market.
Stop. Can you read what I highlighted in this moment? Can you see the mouse?
Yes.
So what is highlighted in this moment? Which was?
Security.
Okay, so should be a sample of what?
Sample of stocks, securities.
It's a sample of securities. Okay, but the question was, what is a sample? Let me ask someone else. Tanya?
It shows, well, it represents the market. For example, if we're looking at the US market, we look at the 3 indicators, for example, NASDAQ, S&P 500, and I don't know, Dow Jones.
No.
And
Tanya,
it shows the movements, so it's just an indicator.
Tanya, that is the meaning of index, it's fine. But we are talking about the meaning of sample. What is the meaning of sample?
It is an indicator of how the market moves.
No, that is the meaning of index. What is the meaning of sample? What is a sample?
One of the components?
Who knows it?
I know.
Maybe it's Spartan or something.
So just a second. Who said it? I know.
I know. Fyodor.
Fyodor?
Yes, a sample is some members of some set. For example, we can take a sample of blood. It's not all the blood in our body, it's just a droplet. And if we are talking about securities, for example, that would be some securities that are traded on the market, not all of them.
Okay, let's make an example. Let's say that we want to know which kind of car or which kind of Apple, whatever you like. How we can say that the total population is represented by a small set of the population, because how many million of people are in Russia?
140.
Okay, 140 million. So can we ask to 140 million if what is their preference about a car, or the preference about, I don't know, the Apple, a kind of Apple? Yes or no?
No, not really. No.
Sorry?
No.
It would be very difficult, very expensive, very time consuming, and so on. Tanya, is clear this?
Yes, I understand.
And then we have to identify a sample. And what is a sample? We said a subset. So if we talk about Russia, we need to find a subset, so a small number of people that is Russian, correct?
Correct.
And then what you have to do? Maybe you don't want to ask only guys, you want to ask also girls. Yes?
Yes.
So you want some girls and as well as some boys. And then maybe you don't want to ask only people from Moscow, but you want to ask also people from Yekaterinburg, from, I don't know, Belgorod, from St. Petersburg, and so on, okay? It's clear what I mean?
Yes.
And then you don't want to ask only people that are young. Maybe you want to ask young people and old people. And so on. So a sample should represent Russia in terms of location, and we said several cities. In terms of population, and we said that maybe there is a proportion of 50-50 between male and female. Should be in terms of education, should be representative of the complete full population in terms of, I don't know, income and whatever. It's clear what I mean?
Yes, we have studied statistics, and we do know what is a representative sample. And
okay, you couldn't say what is a sample. So that's
in most cases it depends on the formulation of question, because not all the people just understand.
Well, I just asked what is a sample.
Yes.
The question was not so difficult. Sample, that's it.
Everybody knows what is a sample.
Well, but you didn't say it correctly then.
I said nothing. I just wanted to say, but yeah.
Okay, good.
Other people.
So then, what are the I guess that we need to stop now because we have the what is it? We have the interval, no?
Yes. It's the end of the lecture. Well, should be.
So we will meet in what is it? 30 minutes? Let me check.
We'll meet in 2 days.
Yeah, we don't have the second lesson today.
We don't have a second one.
Yeah.
Let me check because here I have 15, 20. Sorry, I have seminar group at 17:10. And you don't belong to the group 2, correct?
Some of us.
Okay, so some of you will follow the class later. Okay, at in 30 minutes. Is this right?
Probably the first group, but I don't know. I'm not sure.
Let me check it. Here it's written seminar group 2.
I'm just looking at my personal schedule, and it's written that our lesson is going to be on Thursday. I mean the second group's lesson, because I'm from the second group. Could anyone just check it out?
And
Yeah, actually,
I'm from the group 1, and I have the same in my personal schedule. I have a seminar on Thursday.
So no one has a second session, correct?
More yes than no.
We don't have, yeah.
Okay, so we will meet then next time. So that would be, we said the 15th, correct?
Yes.
So as we finish the class, let me just end this slide. So as we don't start the new class. So what are the characteristics of a sample? Then should be replicable. So what is the meaning of replicable? That whoever has the data should get the same results. So if I tell you what are the rules in order to build this sample, and I give you the data, you should get exactly the same result than anyone else. So this is about replicability, and then regarding the representation is what we said before. So we need, for example, to incorporate the characteristic of the population. That means what we said before, that well, we need people from Moscow and St. Petersburg and Belgorod and so on. We need male and females and so on. Okay? That's all. Okay, so I wish you a nice afternoon or evening, whatever. And then let's talk. Let's meet the next time. That will be, we said, the 15th.
Thank you.
Thank you.
Goodbye.
Okay. Bye.